This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 149. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@SNNWire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. I'd like to wish everyone listening a very happy, safe, and bountiful Thanksgiving. Our shows this week from the SNN Podcast Network are focused on this theme, thinking about what we are thankful and grateful for in a year that was, putting it lightly, it was a tough year. It was very difficult for so many of us out there. So, I wanted to dedicate a week to giving thanks and really talking about what we're grateful for. But first, a quick reminder, the SNN.Network Canada virtual event is coming up on January 6th and 7th, 2021, with lead sponsor Small Cap Discoveries, one of the leading Canadian small, micro, and nano cap newsletters. We have teamed up to highlight our neighbors to the north, Canada. We have our initial speakers up there right now, so be sure to check them out. Many more speakers that will be announcing and presenting company lineup is filling up quickly. I'm really pumped on what we have lined up for you all, so be sure to register now on Canada.SNN.Network to join us for an incredible microcap event to kick off 2021. Go to, again, it's Canada.SNN.Network to register. Like I said at the beginning, this week on the SNN Podcast Network, it's a Thanksgiving theme. Starting with In the Market Trenches with Gary Reeby and Eric Fure, our hosts chat about what they're thankful for this year as investors. Check out this episode on Apple, Spotify, YouTube, or Podbean at inthemarkettrenches.podbean.com. And on the Investors Roundtable this week, our panelists and I will be discussing what we're thankful for this year, again, as investors. And you can watch this episode on the SNN Network YouTube channel at youtube.com/SNNWire. Now, for this episode of the Planet MicroCap Podcast, I spoke with Keith Beverly. He is the managing partner and CIO of Grid 202 Partners. Keith participated on a panel at our August 2020 virtual event titled, and I quote here, "The Business Case for Changing the Landscape of Financial Services," end quote. That explores how we can make financial services a more diverse and equitable ecosystem. I'm excited to share my chat with Keith because he is a pioneer in the financial community. After getting his start in finance working at the Motley Fool, he could have easily gone in the stock picking route and direction, starting a fund or asset manager. However, Keith followed his passion for closing the wealth gap in the United States, and his solution for doing so was using a holistic approach through sound financial planning. Listen in as Keith describes Grid 202's approach to building generational wealth with impact and discipline. Thank you again for tuning in to episode 149 of the Planet MicroCap Podcast, and please enjoy my interview with Keith Beverly. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and I thank you all for listening, and I'm really excited about our guest that we got here today. This is a gentleman that joined us on a panel that we did at our event back in August titled The Business Case for Changing the Landscape of Financial Services. This was an incredible panel, and I'm really excited that he's back to do a one-on-one interview where we might touch on a few topics that we talked about there today. But in general, I want to get a story. Let's learn the full thing. So with that, we got Keith Beverly. He is the managing partner and CIO at Grid 202 Partners. Keith, thank you for joining me today. How are you doing?
I'm great, Robert. How are you? Thanks for having me, man. I appreciate it.
No, of course. And look, I got to apologize. Look, I haven't gotten a haircut in a couple months, and I just had to do it. I had to go hat. I know that's a little too informal, but I put on a
That's
shirt.
fine.
That was
Yeah, I appreciate that. I appreciate
yeah.
that. And you'll have to come to North Carolina and visit my barber. So he just hooked me up this past Thursday. I always go to my barber. So it's my last visit before I get on the road. So I'm actually in DC right now. So I got to make sure I get a fresh cut before I hit the town and get on the road.
Hey man, DC is the place to be right now. I'm sure. I mean, it must be. When did you get into DC? Just recently?
Yeah, it came in yesterday. It's kind of yesterday.
Yesterday. Is the vibe still going from Saturday?
Yeah, I think it's more quiet now. So I missed the hoopla over the weekend. So
you got the haircut. Quiet. You showed up. You're like, come on, I just got a Fred haircut. This is
right. And then it's quiet. Yeah, it's the story of my life, though. Story of my life. I always miss the good stuff.
Oh man. Well, I look. I know we're gonna get into it. I hope that's not the main theme, but look. So we get the lobster roll that doesn't have all the lobster in it, but
it happens.
It happens. All right, Keith. Well, let's dig right in, man. I'd love to get your background and really, where did your passion for investing begin?
Yeah, my passion for investing began when I lost a ton of money in my first stock. So that's really when I was hooked, as might say. But I got a hold of one of my dad's Schwab statements when I was like in my early teens and started investing when I was in high school. So I saved up a ton of money over the course of a summer, invested it in one stock. Stock proceeded to fall precipitously and like became a penny stock after I bought it. I think within a year or so. And then, after that, I decided I was going to, learn about investing and be more knowledgeable and never make, at least if I was going to lose money, I was going to do it in an informed way, right? I was going to be educated about my loss and at least understand like why I was losing money. So I vowed never to make another uninformed investment decision after that. So I've been, hooked ever since. So it started pretty early.
I got to ask about that story. I mean, you don't have to name the name of the company, but what would you say was like the main, what enticed you? And then what was the lessons learned from that one?
Well, it was more just going off of the, my father recommended a few stocks. He's like, looking for something that was a tech stock that was, it was in the semiconductor space. And, that was a booming industry back then. And it was one of the players that just didn't survive. But, for me, it was a great learning lesson. And, you save up a ton of money, invest, and then it goes nowhere and you lose a lot of money. And then you dust yourself off and live to fight and live to invest another day.
Absolutely. So I know talking to you off camera, we discussed a little bit about your background and how you actually, you cut your teeth at the Motley Fool. I feel like I should do like a full documentary on like the Motley Fool factory of investors and advisors that came out of there, because it's pretty incredible, the lineup of people. So can you tell us a little bit about your experience there?
Yeah, so when I was at the Fool, worked on
The Fool. I love that.
Newsletters.
Like anybody who works, it's the Fool. When I was at the Fool, I love it. All right. Okay, sorry.
Yeah. So 2 newsletters. So Hidden Gem and Pay Dirt were the newsletters I focused on. So in the small cap space, and actually Pay Dirt was more in the micro cap space. So I don't know if any of your audience would be familiar with it, back then, but it was a great environment. So other investors who were very sharp and passionate about the work and passionate about educating other investors, which is really something that stuck with me. And, it was when I first, back in, when I was early in investing, when I first started, learning about investing, when I was in college, I want to say, like my sophomore year of college, freshman year of college, I spent a lot of time on the Motley Fool's website. So I really credit them for like laying a pretty strong foundation around investing and wanting to invest in individual stocks, at that age. But it was a great environment. You come to work every day and everyone's, great writers and, not a pretentious environment to be in. And, it was a wonderful environment, like nothing but positive things to say about my time there. So, I mean, the way it was structured, like we each had, each analyst had, probably somewhere between, 10 to 20 names that they covered. And with the Fool, they have very active message boards, right? So if you covered a stock, you would write about a newsletter, and then kind of monitor and respond to the activity that was taking place on the message board. So it was good. So from an education perspective and what they've done for just the investment, the investment world, and for active do-it-yourself investors, it's a great resource.
What would you say were some of the things that you took away from that experience, just in whether it's from just incorporating into your own investing philosophy, how you're now running Grid 202 Partners? I mean, there must have been tons of stuff that you're like, do we got time? Because I'm sure.
Right. Well, I think just investing in individual stocks, right? So it's somewhat it's out of favor, right? Because there's so much emphasis on passive investing and ETFs, and you can't beat the market. So I mean, the fact that the Fool has carved out a niche for themselves amongst people who actually invest in individual stocks was something that has been with me ever since I left there, and during my time there, it was great to be in that environment, because even back then, like, the trend was going more towards mutual funds. So not as much ETFs, but still, why do you want to invest in individual stocks as opposed to owning a basket of stocks and reducing your risk? But when it comes to wealth building, I'm still partial to individual stocks, and probably one of the few wealth management firms that still invest in individual stocks in their client portfolios. So the trend these days is put everything in ETFs and call it a day. And for us, we do utilize ETFs in across several asset classes. Your more efficient asset classes, but I don't think is uncommon. But we do also like to invest in individual stocks. I think I credit the Fool for some of that.
Very, very cool. I mean, I'm sure there's some micro caps that somehow slip into a few of those. Probably not, but there might be a few.
Yeah, not right now.
Fair enough.
Not right now, but yeah, I think if we have more resources, probably, yeah, for sure.
Fair enough. Well, hey, I my last question on your time at the Motley Fool, because I have to ask this in MicroCap Podcast. You as you said, you worked a little bit on the MicroCap newsletter, a little bit sometimes. I mean, what was some of the fun stuff that you learned about microcaps and penny stocks during that time?
You have to do your research, and you have to be very diligent, right? So it's not for the faint of heart, and the interesting thing, well, I guess the important thing about investing in individual stocks is like knowing your risk tolerance. And for some people, you just need to set aside a certain percentage and not deviate from that percentage, and be disciplined in it, because you can come across a name that you think has a ton of upside potential and is a great greatest story ever, and lose your hat on it. So you want to be just mindful that you want to, if while being aggressive and taking risks, that you're still conscientious about the risk that you're taking, and doing so in a judicious manner. So so caveat emptor. So buyer beware. Invest and do your thorough due diligence, but don't be afraid either. So.
All right, so Keith, catch us up. All right, so from your time at the Fool to then founding Grid 202 Partners, what fill in that gap for us?
Yeah, so after I left the Fool, I went to business school, and after I graduated, I started my first RIA prior to starting my current RIA. Really, with the thinking that there was this demographic out there that wasn't being served by advisors like me. So the CFA, CFP crowd went to got the MBA and have all these letters after your name. For the most part, those folks are only working with the ultra high net worth households and institutions, right? And for me, I have no issues with the ultra high net worth clients. We want to bring more of them into the firm. Grid 202 Partners, check us out. Keith Bev CFA, that's my Twitter handle. Slide into my DMs. I have no problems with that. But for me, looking at the impact I wanted to have, I knew that wasn't going to be the only demographic I wanted to serve at my practice. So having some diversity in clients and having some flexibility where we can work with clients across the income and wealth spectrum was important to me. And I didn't see a way where I could do that at a big firm, and at a firm that was going to pay me market salary, coming out of school. So it just found myself in a predicament where, okay, well, if I graduate and I go and make market salary in my field, like what role would I have and who would I be working with? And a lot of my friends and people in my network, I just wouldn't be able to serve. So it was important to me. And fortunately, over the past 10 years, I feel like the industry has kind of caught up to my vision 9-10 years ago, where now you have different models of how you can work with people that aren't necessarily millionaires or multimillionaires, and you can still do well financially and have a comfortable income doing so. So it's been good to see that evolution over the past several years, and I think our firm is well positioned to keep moving in the right direction and to capitalize off of what we see as a very attractive market to serve that continues to be underserved, at least when you talk about advisors that have our types of experience and backgrounds that we're bringing to the table.
So I wanted to ask you about that, because that education process must have been pretty tough. I mean, you're talking to potential clients coming in, and they most RAs, CFPs, or advisors just in general have been serving that millionaire, high net worth crowd. What were those initial conversations like? With like, I don't have that much money. Why are you talking to me? Like, what can you do for me right now?
Right. No, definitely, it's a very good, valid question, and for us, always comes down to value, right? So you're making this amount of money. How do we justify our value? So, we kind of hang our hat, as much as I love investing and, individual stocks and doing analysis and the market commentary and the research, where we really hang our hats on is the financial planning piece, and just being like that go-to resource for all of our clients when it comes to anything that has a dollar sign attached to it. Like that's the way I frame it with clients. Like if there's a decision you're contemplating, a decision that's top of mind for you that has a dollar sign attached to it, you should be thinking about us as a resource and reaching out and getting our thoughts on it. And for that value, there's a dollar amount that makes sense for the clients and for us. And I think we're doing a much better job of articulating our value, and then also making sure that the revenue that we're deriving from the client relationship, makes sense from a long-term, business perspective.
I had a question for advisors that I don't know why it's taking me so long to even ask, because, I speak with a lot of fund managers on here, asset managers that are just focused on picking stocks, that kind of thing, building portfolio. Why for you was it important to be more on the wealth management side, where you're doing not just that, but also doing the financial planning, rather than just going into on the fund manager's side and picking stocks? I feel like that was a pretty critical decision in your thought process.
Yeah, it was. And as much as I love, individual stocks and investing in individual stocks, when you look at the impact you have. So if you're in microcaps, what's the largest allocation that you would recommend or anyone have to microcap stocks? Maybe 10% on the for an uber aggressive investor. Would you recommend anything above 10% on like?
I'm probably the worst person to ask that, because there's most of my audience is like 100%. Yeah, I mean, like
outside of
I like risk.
Outside of let me qualify it by saying outside of a professional, microcap investor. So, your dad or mom.
Also terrible person to ask him. Also loves microcap.
outside of the craft lineage. Let's move to, the Jackson family, like down the street from you. what would you say is the reasonable, the max they should have in microcap? So
you're probably right.
Maybe 10%, right?
Yeah,
right?
at most,
maybe 10%, right? So then you think about, okay, well, how much impact can you have on, a household, with that 10% allocation, right? And then that's just their investment portfolio. What happens when that investment portfolio grows and they need to pass it down to their heirs, but they, haven't taken the right steps from a estate planning perspective, and they're paying a ton of money in taxes, and now the government is getting a large share of that portfolio that should have passed to heirs. What if there wasn't insurance in place, and now the surviving spouse is in a tough situation financially. Now they have to eat through the portfolio and literally to survive. So I think when you look at the impact you can have as a financial planner, like the investment side of things is going to be, I think fair to say, is going to be the most critical component of most households' overall financial plan. Like the investments is probably going to be like the central component of the plan. But those other areas are extremely important as well. So when you talk about the impact you want to have on individual lives, financial planning and having like that comprehensive approach, and really looking at the relationship as a holistic relationship is made the most sense for me, right? Because I can affect that 10% of the portfolio, but what about the other 90% on the investment side, and what about all these other areas of that come into play when you're going through the financial planning process?
Gotcha. All right, so my next question, it really kind of harkens back, I think that's the right word, harkens back to the panel that you participated on back in August about changing the business landscape for the financial community. The business case for changing the landscape of financial services. That's the official title for anybody that wants to go back and check out that panel. And this ties in a lot to your firm's philosophy. And, you gave an answer on there that was really quite impactful to me when I heard about it, because you really are at the forefront as somebody who has been changing the landscape of financial services for a long time now. So I'd love for you to kind of give us what inspired you to really go into business for yourself, and how Grid 202 has been part of this change that you've been seeing.
Mm-hmm. Yeah, so we are a diverse owned firm. So for everyone looking at this, I am African American, and we have several African American advisors who are at the firm. And right now, we just have the latest results that the CFP board has published. I think it's 1.5% of certified financial planners are African American, and there's a dearth of us in the industry, and it's been a passion of mine to make sure that changes. And one way that we change it is by having successful firms that can recruit other advisors of color. So I'm excited to say that one of our advisors just yesterday passed the CFP exam. So she'll be one of the few Black women in the country who's both a CFA charter holder and a certified financial planner. I know two other women that have two other Black women who have both those designations. And it's great that she's at our firm. So I think for us, there aren't a lot of firms that look like ours, and especially that have our caliber of professional with the backgrounds and experiences. And we just have a very talented team, and we're looking to build something special together, and work with households from all different races. But obviously, when a household that wants to give some consideration to a diverse firm is in the market for a diverse advisor, and they go to our page and they see a lineup of advisors with impressive credentials, more than likely they're going to give us a shot and reach out and consider us in their selection process. But yeah, it's been a passion of mine for a very long time. So generational wealth is important across all communities, but particularly when you look at communities of color and that huge gap in wealth. How do you address it? One of the ways, back to my point earlier about how you can maximize your impact. One of the ways is by well, and I would argue the most powerful way is through sound financial planning, right? So it's through, making sure that people have the right allocations in their portfolios, making sure they have the proper insurance coverage, making sure that they're mitigating taxes as much as possible, making sure that their estate plan is solid and they're passing down their assets to their heirs in a way that's consistent with their values, but also is going to be, prudent and smart from a financial planning perspective. Like all those areas, when you look at the totality of their impact, there's a lot that you can do there. Especially when you're talking, with a group that predominantly hasn't had the same level of exposure to financial topics, and weren't having conversations around a dinner table about microcap stocks growing up. So bringing that education piece is important, and it's it's essential right now. And we're also finding that people really are at a place in a moment where they're yearning for knowledge, right? Because there's so much of it. And in some ways it's great that, you can Google something and do an internet search in a few minutes and, get up to speed on different topics. But there's so many sources of information. Having an expert that is knowledgeable, that has your best interests at heart, and is going to help you make sense of, all these different sources of information is becoming, very valuable, right? Because, people know that they can, we have a lot of smart clients, a bunch of, folks with, impressive credentials in their own right that are, I'm sorry about that, that are coming to us to, delegate the financial, planning and investment management for them, because they could, if they wanted, do it on their own. They could read it, read a ton of books and consume that knowledge, that information. But do they want to do that, or do they want to spend more time with their kids, or do they want to spend more time mentoring, or spend more time engaging in some activity that's going to bring them joy? So they choose to delegate that responsibility to us. And yeah, but we're fortunate to be in a position where we have clients delegate their investment management and financial planning responsibilities to us.
Very good. So, I mean, Keith, what it sounds like your firm, and it seems like your firm already has a pretty strong foothold. It's a well-known firm, many clients, very successful, bringing on new advisors, which is amazing. But it still seems like it's really difficult, because there seems like there's an education gap that you're also trying to fill at the same time. So, other than doing podcasts like these and, blogs and all that stuff, I mean, what are you doing from a firm perspective to continue to be able to reach out to as many different clients that are being underserved right now?
Yeah. So we do lots of webinars, lots and lots of webinars. So we have a spreadsheet that we run. I haven't looked at it past few weeks. I think we've done a couple of past few weeks, but like we reached over 500 people through webinars, probably like 600 or so right now, over the course of the year. So, webinars we did one with the city of Annapolis. We've done some with sororities, partnered with other organizations or other companies that have large followings and done webinars for their community. So, that financial education piece and, webinars for us have been one of the go-to vehicles for just disseminating knowledge. And it's been great, just engaging with folks that, may or may not come on board as clients, or might not be a good fit as clients, but just, sharing information with them and, sharing our expertise is something that everybody on the team is passionate about. So I'm going to say all of us have participated in webinars, and, people have no problems reaching out and finding us and engaging us.
All right. So I have to ask, what's the most fun and the most difficult part of your job on a day-to-day basis? Or if you got an anecdote in there, I'm sure there's an anecdote.
Right. The most fun part, I love our huddles. I love our weekly huddles as a team. Everybody gets on the Zoom call, and it is. So we are remote. So none of us now. So for a period, we had 3 advisors who were all in North Carolina. But after I say once we go into 2021, we won't have any advisors. We won't have more than one advisor in any one state. So we'll have I'm in North Carolina. Camila's moving to Atlanta. Brian's in Denver. Ken is in DC. Deborah's in LA. Well, San Francisco. Sorry. Whitney's in Columbus. Big difference. Sorry. No offense to either side there.
I'm just messing.
Whitney's in Columbus and Jose's in Boston. So we're literally all over the country. So having those huddles and everybody come together has been great, and it's a great jump start to the week for us. As far as things that I could definitely do without, paperwork and operations. So operations and systems, like that stuff, I just in compliance. Like those are like the three things where if I didn't have to do any of it, it'd be too soon. I can just I had to do any more paperwork for the rest of my life, I'd be fine with that. Just let me sign. And you don't even need I don't even need to sign. You can just electronically sign for me. So those are probably the biggest headaches and what I wish I could do without.
Fair enough. All right. So I want to dig in a little bit to the firm's investing strategy. Well, I know this is an investing podcast, so I know I hammer home a lot of investing-y type questions. So, and I know this changes probably from client to client, but let's say when a client comes to you at first and says, "Hey, Keith, well, I'm not sure what my investing strategy is and or should be, so what's your strategy and your criteria, and then work off that." So, I'd love to know what your investing strategy and criteria is for you personally.
Yeah. So, for us, we do consider ourselves active investors, right? So, and there are a lot of advisory firms that are, strictly passive, and it's very common these days. And, I totally understand it. But, back to my experience at the Fool and just, my background as an investor, I never saw myself, being a 100% passive investor. But what it looks like with active management rather looks like for our clients is a mix of passive and active mutual funds, and then some select stocks. So we have a portfolio of 8 to 12 stocks at any given time that we invest in. We call it our select equities portfolio. And I consider myself a thematic investor, right? So we look at what's going on in the macro environment, try to distill some dominant things we think are going to play out over several years, and then we invest in them. I mentioned passive. For the most part, our passive investments are going to be in asset classes we consider most efficient. So probably no surprise. So a large cap value or bond market, kind of treasury bond market type investments are we aren't looking for active managers in those spaces. When we do look for active managers, we want to see a high active share. We're comfortable with them holding, concentrated positions and really being true active managers and, not closet indexers. And then we're also these days doing more in the alternative space as well. So looking to identify some private market opportunities for our clients. And, what we find for us is, the impact piece is important. So we are ESG sustainable investors, and we do believe in impact investments. But we also believe that you don't have to sacrifice returns in order to achieve impact in your portfolio. So what that looks like for our clients is understanding one, what's your return objective, right? So your return objective is 7%, long-term 7%. How are we going to get you to 7% or greater, ideally greater, and do so in a way that's aligned with your values, do so in a way that is going to incorporate social causes and issues that are important to you, and have that be reflected in your portfolio. So that's what it looks like as for great clients to for us to build a portfolio for a great client. So, understanding what the return objective is, understanding risk tolerance, and then layering on their, impact objectives and what they want to achieve in that realm.
Very good. That actually ties into my next question quite a bit because, this is one of the questions I had earlier, but we got on tangents, so we went on the tangents.
Yeah.
It happens here. As it states on the firm's website, right then and there, your philosophy is generating returns with impact and discipline. You spoke to the fact that you're looking at developing impact and ESG portfolios depending on what your client's risk tolerance is. And then you actually have a blog post as well on the website titled "4 Things the New York Times Gets Wrong About Impact Investing." So I'd love to hear a little bit more about what impact investing and ESG investing really means to you. And then also, what does the general public get wrong about impact and ESG investing?
Mm-hmm. Mm-hmm. So one, and I think I can't say this enough. I'm a pretty competitive guy, Bobby. And I think that's one of the reasons why the markets tend to attract competitive people, right? Because either you beat the market or you didn't. And it's just right there, very clear as to what your scorecard is on any given day or any given period. So for me, I don't know if I'll ever embrace the notion of just kind of achieving a market rate return, right? So I want to do better than whatever the benchmark is, and I think that's always going to be the case. So for us, one of the biggest misnomers that we address with our clients is that so we want to achieve great returns for our clients, but also make sure that the impact is going to be reflected in their portfolios, and we're investing in a way that's going to be consistent with their values and beliefs. And that looks different for different investors. And I think when you look at where the industry is going, at least where I see the industry going over the next 10 to 20 years. So firms that are able to more customize their experiences for their clients and really build custom portfolios are going to be the firms that clients will gravitate to. And I think the impact piece and the responsible investing piece is going to be central to that moving forward.
So as you mentioned, you're a competitive guy. You want to beat what the normal market returns are,
Yep.
And I think the biggest myth that people have out there when it comes to impact and ESG investing is that you can't beat that if you just have an impact and ESG portfolio. So, the main point of your blog post that I took away from it is you actually can, if you follow a certain formula and not necessarily following exactly what Keith Beverly and Grid 202 is doing, but just in general, you still can. So, from your perspective, how is it possible to still generate great market returns while thinking about how I can just in line with your values, more or less? Because that's really what impact investing is.
Right. And if you want to, so if you're a proponent of clean air, right, do you think that companies that are going to help bring about a more cleaner environment, that are going to improve the environment overall, are going to do better or worse than companies that are harming the environment? I think long term, companies that are being more productive and more responsible when it comes to their impact on their environment will do better, right? So that's an investment theme, right? So that's an ESG theme, and that's an ESG theme that I would expect would outperform over time, right? So one of the things that we're focused on right now is figuring out how we can make racial equity an investment theme, an investable theme, right? So right now, if you said you want to invest in companies that are at the forefront when it comes to racial equity, there's not an easy way for you to implement that strategy in public equity markets right now, right? So that's one of the things that we're figuring out and building some strategies around as to how can we, looking at public equities, use racial equity as an investment theme, right? So over the next 10 years, companies that have a more diverse workforce, that treat their employees of color better, that are able to tap into diverse markets, will they outperform or underperform the companies that are lagging in that space? My thesis would be that they would outperform, right? So, but how do you then build a portfolio? How do you then invest in those particular companies? So, the way we think about ESG is, what are some enduring themes that, from an investor's perspective, that should yield outsized returns over long periods, so next 10, 20 years, and then how you position portfolios, how do you invest in securities that are going to participate in that growth and in that theme.
It's interesting. We were a theme that we talked about on. I have another podcast show called the Investors Roundtable. Once a week, we talk about a topic and kind of just shoot the shit on all sorts of different things. But one thing that we talked about now a couple times is, because this is very pertinent, especially in microcaps when you're analyzing every little bit because it's such high risk, is talking about cultural moats. And I think when it comes to trying to put together a racial equity strategy, I think there's a lot to, rather than even focusing on, individual sectors, which is definitely important as well. But I think even ahead of that might be trying to understand, well, how do you quantify what a cultural moat might be? Because I think a lot of the themes that you're saying would then result in greater productivity and just an overall better company. Wouldn't you agree?
Yeah, I do agree. And so I'll give you some insight as to our methodology and how we're approaching it. So what we're doing is, you talk about culture. So another way that I would frame it would be belonging, right? So we're like, do you feel as though you belong at this particular company? And we're working with a company that has survey data from millions of employees across the country, covering over 150,000 companies. And right now we're looking at S&P 500 companies and looking at how employees at those companies rate that company, right? So, and looking at those, looking at employees by gender and also, by race. So if we see a connection, that if we see that a company has, like, on a scale of 1 to 5, if a company is a 1, right, and they're in the technology space. So let's say it's an IT firm. Let's say you're looking at in the IT sector, and you have a company that has a 1 and a company that has a 5, right? Our thesis would be that the company that's rated a 5 by their employees would outperform the company that has a 1. And when you layer on race and looking at employees of color at those companies, the same thesis will hold. So that's how we're approaching like that. Carving out the racial equity piece as an investable theme for our clients. So that's like the core of the strategy in a quick 30-second description.
Yeah, I have a feeling we could do a whole nother show just on the whole strategy itself. Yeah, but I mean, if there's anything else you'd like to say about the strategy, before I go on to the next question, is there anything else you want people to know about how you're trying to make that strategy work?
Yeah, I think, well, when you look at microcaps, just, to your point about risk, if you're, it would definitely be, if I'm examining a microcap company and I see that they are rated low on that scale from their company, their employees of color, from their women employees, to me that would definitely factor into the due diligence process and whether or not you decide to put dollars behind that company. Because if they are a poor performer in that area, to me that suggests that there's some cultural issues that would probably not bode well for them long term, right? So if you're having problems retaining, let's say you're having problems retaining women at your company just aren't happy, and you're an apparel company, right? What does that say about your prospects for apparel when you want to tap into the female market and the trillions of dollars that they command and spending annually, and you have a you have a class action discrimination lawsuit that's that can happen at any moment, right?
I feel like we're thinking of the same company like right now that we're just not saying, but it's like right here. But I get what you're saying.
Right. So I mean, but those types of risk factors, like they have to, if they aren't playing into your calculus as an investor, then you probably have a flawed process for how you're analyzing companies.
Well, here's another question I have, because this is something that bothers me a lot. as when you're just talking in general about wanting to look at companies that or matching that score of having having a diverse employee set, right? Having a lot of different women, people of color, just across the board, and like what do you say to people that say, well, what, they need to have a quota or this and that? Because I think that's just the biggest misnomer about this whole point.
I lost you at like biggest, so it was very appropriate.
Like your biggest, I was like the biggest misnomer in this entire argument of I mean, it almost goes back to like the idea of affirmative action, which this idea of like filling quotas and stuff like that, where at the end of the day, and I think I saw it though, that either you had data or somebody else did, that when you have a more diverse and really just happy workforce, that actually shows that those companies tend to succeed more often than not. This isn't just like we're just trying to fill that. What do you say to people that like just it's still not cutting through, that idea? It's so annoying. I'm sorry, I don't even mean to ask, but it's just so annoying.
Just invest how you see fit. And I think you're going to lose money. Yeah. Like that. Like that's the way I would approach it. Like, okay, if you think that company that has these glaring potential red flags when it comes to how they're working with or how they're addressing communities of color, how they're dealing with women, how they're dealing with the LGBTQ community, if you think that they can get away with it and their stock perform and outperform the companies that are doing an exceptional job or are really at the forefront on those issues or dealing with those communities, then put your money behind it. That's how I would address it. I wouldn't. I think at this point, there have been so many studies and empirical research that support the notion that more diverse firms, when you look at gender, when you look at race, are going to outperform those that are less diverse. Like the case has been made, and if you don't believe in the case, if you don't believe in the empirical data, then put your money behind it and let's see how your portfolio performs compared to ours.
That's right. Let's compete. Let's go.
Again,
I think you're right.
Back to the market forces. Back to being a competitor. Like, all right, put your money up. Let's see how you do.
I love it. All right, so we're at that point in the interview where this is my favorite question to ask every guest that I have on here. So what would you say is an investing experience, other than maybe the very first one where you lost all your dough? What was an investing experience that you would say impacted you the most in your career?
Yeah, so I lived through and invested the financial crisis, right? So and I was at the Fool then, right? So I was at the Fool when markets tanked, and it was funny. I was just like, before this interview, this is a funny story actually. So this was in March. So March 2009, and there was one of the up days for the market. It was like right when we had nobody knew that we had come pretty close to the nadir at that point. But I had I wrote something to our subscribers and said it was the markets are probably up like several percent. I said, I'm gonna cheer this market on. I'm gonna do my part, and I'm not gonna change my underwear until the market goes down again. This is an article. I'll share the link with you.
Yes, please.
But for me, having that that mentality of just like the classic Buffett stuff, right? So everyone's being fearful, be greedy, and like when things look the most dire, that's the time to be aggressive. It's one thing to talk about it; it's another thing to be in a cubicle with people buying what do you call it? The leverage financials ETF, literally in 2009. So I mean, I was like investing, but I wasn't I wasn't investing in leverage financials. I wasn't investing in 3X finance sector in 2009. But some people were. Some people like in our circle like, okay, all right, okay. I'm gonna get in. I'm gonna not sell and not do anything crazy, stay invested. But that level of risk. But it worked out well for him, right? So having like that type of temperament, that type of discipline to really be aggressive and put your money and your dollars behind what you're, and it's also different when you're communicating to people on a very regular basis, like your thoughts and how in your strategies and what you're seeing in the market, but then putting your your dollars behind it. So I say working and investing through that, and then communicating with subscribers, and you have positions that you've studied and companies that you feel good about, that you see down 10, 20, 30%. Or more. A lot of the pay dirt stocks were down a lot more than that. So you launched it was the early days of a distressed special situations microcap newsletter, like in 2008. So you talk about like the worst timing ever, for a service. But working through that, living through that, having to explain and just communicate to people that were invested in things that you had recommended to them it's very humbling. It just puts you gives you a different appreciation for your role as an advisor and for someone who's managing someone else's money. And even though directly at that time the Fool wasn't managing money, I mean, you're still in a quasi fiduciary role, in my opinion, as a newsletter service that you're recommending people invest in particular companies.
Oh, absolutely. All right, so we're there. I'd love to close out this interview with your advice for new investors out there, or actually maybe there's people listening to this that are looking for a potential advisor or financial planner. What are some things? What's your advice to that group?
Yeah, I'd say my advice would be learn from the masters. So do your reading and do your research on different investors, all types of investment themes out there. Like there's no right answer. So there's no perfect way to invest. There's no perfect investor that's out there. So I'd say learn from the greats, so to speak, but also put your own personality on your portfolio and your investment thesis. And this is for the active investors. I mean, the do-it-yourselfers probably aren't even looking at me. The passive folks probably aren't watching your podcast. I don't know if that's your crowd, but for the active investors, learn from the best, but put your own spin on it would be my advice.
Very cool. All right. Well, with that, Keith, where can my audience go and find everything they need to know about you and Grid 202 Partners?
Grid202partners.com is our website. I'm on Twitter, so Keith Bev CFA. Very easy to find on LinkedIn as well. I think my LinkedIn is just linkedin.com/Keith Beverly CFA CFP. I want to say, but very easy to find. Just Google Keith Beverly CFP and you'll find me. And the email is keith@grid202partners.com.
Perfect. All right. Well, Keith, thank you so much for doing this. I really do appreciate it. Good luck. Stay safe. And I look forward to our next chat.
Yeah, definitely. This was fun. Thanks for having me, Bob.
Thank you, Keith. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.